What I'd like to do is very briefly go through the major provisions of the American Taxpayer Relief Act of 2012 that was passed on January 2nd, as well as to remind us of the Obamacare taxes that became effective January 1st of 2013, which in my opinion were just ignored in the debate. There was a lot of conversations about we're just restoring rates back to where they were pre the Bush era tax cuts. That's not true, because over and above that, we had 5 major taxes through Obamacare that are being implemented at this point in time. The third thing I'm going to mention briefly, corporate tax reform. And in particular, I'll probably concentrate a little bit on some of the international issues that we're facing, because it is a huge part of future tax planning. I will then go through some brief tax planning opportunities that are available and that a lot of our clients and other clients are considering to implement. And then finally, I'll talk a little bit about the future tax battles that we have coming. Realistically, we just delayed the fiscal cliff by 2 months, as well as we didn't address the debt ceiling. And then obviously we basically have not implemented any additional spending cuts at this point in time. So I'll go in quickly, and what I want to do is work through the Taxpayer Relief Act of 2012 major provisions. There's literally hundreds of provisions again. It's passed so late that forms are not even available to file returns. The IRS won't even accept a return now until January 30th, which is 15 to 18 days later than a normal year, which will delay refunds getting in people's hands and otherwise. But there were significant changes. The most overriding one is the increase of the top marginal rate to 39.6% from 35%. That comes into play for taxpayers with over $400,000 of adjusted gross income or $450,000 if you're married. Capital gain rate, and by the way, that's the full restoration of the pre-Bush era marginal tax rate. Capital gains and dividends were increased from 15% to 20%. This was a compromise provision. If we had not done anything, those rates would have gone back up to the full 39.6% rates for both of them, excuse me, not for dividends, and it wasn't a compromise for capital gains. But I think it's very, very, very important for us that we do have the same rate on capital gains versus dividends, because I do think it's important and make the capital markets more efficient to not punish people to pay dividends to their shareholders. I think there's efficiency that if we can get dividends rates increase and force companies to go out and prove to the marketplace that they deserve capital being put back in them, rather than just capturing capital that they already have, will be efficient for us. A huge relief for me was the estate tax changes. For a short period of time, we had a unified estate and gift tax credit. It was going to go away. That was put in place, or stayed in place, and is permanently in place now, that there's no difference between the credit you get when you die versus if you give it away before you die. Again, I think that makes a lot of sense. I'm happy that they left the exemption amount at $5 million. I would have been comfortable with them lowering it a little bit. I would have been a lot more comfortable increasing it, but $5 million is to me a reasonable level. But more importantly, I was extremely pleased that, again, they unified the gift versus estate tax. And what that did is it makes the capital markets a little bit more efficient. If it makes sense to go ahead and gift that to another generation and let them start redeploying that capital into the economy, they can do it. But prior to the unification of the two, your only option to defer paying a substantial tax was to wait to transfer those assets until you died. And it was very inefficient. The maximum rate did go up from 35% to 40%. Obviously, it's a lot better than the 55% rate that it has been previously. And I think that was a reasonable compromise overall. We did permanently fix the AMT issue. And one of the things I'm real happy with, a lot of these provisions were permanent rather than 1 or 2 year extensions. Historically, almost all tax bills are built on 1, 2, or 3 year bases because the budget office plans on 5 and 10 years. Almost everything's now planned on 10 years. And what they do is they have R&D credit expiring in 2 years or 3 years. And then they show increased revenue for those other 7 or 8 years. So R&D credit has been extended, I think, a total of 18 times now for periods of 2 years. So it's a permanent credit. But for gamesmanship, they're able to show a budget that shows increasing revenues, decreasing deficits in the later years of their 10-year plans. The other thing that kicked in that people don't talk about is the phase out of our personal exemptions and the phase out of our itemized deductions. We've had a holiday from those phase outs for the last 2 years. They are back in place for January 1st, 2013. They effectively will increase high income people's tax rate by roughly another 1% up to the point these are phased out. So you're not really at 39.6. Most taxpayers in that levels will be at 40.6. Education credits were reestablished. The Mortgage Debt Relief Act that allows you to avoid cancellation of debt as income for settling your personal residence has been extended through the end of 2013. And there was a ton of other miscellaneous income tax provisions and business extenders. The most significant on the business expenditures is R&D credit, but there were several others that we can go through, and they're available in your handout.